Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our second August monthly market update to address market volatility. We hope this note finds each of you well. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right in with the most recent data, which is this morning, and we're doing this on Thursday. The consumer spending number jumped in July, up 1%, which is much better than expected, and the market's responding positively to that news. One of the things, it's been a wild week and a half as it relates to where we are today versus where we were on Monday, August the 5th. Over the last 7 trading days, the VIX has declined, the largest in history, down 58% from 38.57 to 16. And just so everybody knows, the VIX is a measure of volatility in the market. So again, largest in history the last 7 trading days. So if we look at other periods of time, I know this is a busy slide, but this talks about the top 20 7-day declines going back to 1990 and what's happened in the market on average 1, 3, 6 month, 1, 2, 3, 4, and 5 year. And kind of what you'll see is that overall, a decline like this is pretty supportive of forward returns. Again, this is a restatement of what we looked at in the prior slide, which is the VIX went from 38.57 7 trading days ago, ending on August 14th, down to 16.19, a decline of 58%, which is the largest decline in the VIX in history. Inflation cooled a bit, down to a 12-month at 2.9. So that's pretty supportive overall to what the Fed is set to do next, which is to cut rates next month. One of the things that's kind of appeared now being more relevant as it relates to the Fed's dual mandate, which part of that is full employment and also inflation, is a very weak July jobs numbers with a negative revision. In fact, 10 of the last 14 jobs reports have revised downward. So this is something to keep an eye on, but it also probably means that now, as opposed to a more singular focus on inflation, the Fed will start to look at a cooling labor market as, again, another reason to likely cut rates in September by at least 25 basis points. As it relates to the last hike to the first cut, on average, that's 10.5 months. If the Fed cuts in September, it'll be a little bit longer than this, more like 15 months. And as it relates to how markets perform after the first rate cut, this talks about going back to 1989, the 12 months after the first rate cut, which again, we're likely to get in September, how different parts of the market do. So what this would indicate, all things being equal, that large blend and large growth are more favored than, for example, small cap, large value, or international. And as it relates to bonds, core bonds, short-term bonds, money markets tend to do okay. High yield bonds are the things that you want to be in less. Again, 12 months on the bond side after the first rate cut. Small cap had its largest, or the third largest in history, outperformance of large caps in July. Before we think, is that a trend, or is that something we should look for as it relates to capital allocation? Small caps still remain in an earnings recession. So the fact that there's been an outperformance in July, and also if there's rising recessionary concerns, small caps are hit harder, isn't a reason that we'll be allocating more heavily towards small caps. We did get some interesting news on the S&P 493, which is the 7 S&P 500 companies that aren't the Mag 7 that's listed here, is that they're scheduled to grow earnings by 8% year over year in the second quarter, which will be the first time that's happened since the fourth quarter of 22. So there has been some broadening out of market performance and earnings versus the concentration that we've seen the Mag 7 have in recent years. As it relates to earnings, we had 91% of companies reporting and 78% are beating, which is above the 5 and 10-year averages. So overall, on the earnings side, pretty supportive of equity prices. We're also at a period of time where money market assets, because those are attractive and rates, have hit a record in May of 24. Generally, after other money market peaks, you'll see this is the performance over 3 years when that's peaked before, and that's been pretty supportive of stocks overall. So we'll continue with this that we talk about a lot, which is kind of the reasons for pessimism is that we get a recession. The consumer weakens. Again, there was a contra evidence of that today with the July retail sales number. We get an inflation surprise. Again, inflation has been softening, so that seems less likely today. Geopolitical remains at an elevated level of risk with the war in Europe and the war in the Middle East. Debt levels in the U.S. remain high. Her earnings have been positive, so this would be less of a reason for pessimism. Election year, we're going to put in both the pessimistic and the optimistic camp. On the pessimistic side, could have a challenged and very close election, and the markets could be rooting for one direction or the other. The reasons for optimism, and this would show up in this morning's consumer spending number, is that a recession is further delayed. Inflation continues to lower, such that the Fed winds up cutting interest rates, which again is almost a certainty next month. And the market performance widens. Again, small caps outperformed large in July, but we don't think that that's a trend. We think that's kind of a one-off because, again, small caps are still in an earnings recession. Earnings are, again, on the optimistic side, 91% reporting and above the 5 and 10-year averages as it relates to beats. An election year on the optimistic side, it will be over here in about 3 months. And the markets can start to digest what that looks like in 2025 and beyond. We will be rebalancing and sending out trade notes soon to talk about the themes that we're allocating towards. So look for that in the very near future. None of this is a substitute to contact us to see how all of these things apply to you directly. So please feel free to reach out to us. We're here to serve you. And so with that in mind, we close. We hope to see many of you in our office or on a Zoom call in the near future to discuss all of these things in more detail. Until we see you again, be well and take care.